So welcome back for another riveting business cycle risk score update for January 2020. I know sometimes these things are a bit onerous, a bit complex, that kind of thing, but really this is the fundamental foundation for how I invest. So that's why I continue to share this. I do it for myself, so I thought why not share it with everyone else who might be interested as well. As a bit of a spoiler, a little bit of rolling over in the risk score month over month, which is interesting because the S&P 500 is rocketing to new highs as we speak. So I always find it curious when the economic indicators are saying one thing and the markets are actually doing another. It'd be interesting to see down the road how the score tracks against the broader markets. So we'll have to wait and see. For those of you who are new to my channel, my name is Jared Ayers. I am a CFA charter holder, been investing my money for over 20 years and have created this little channel to share with anyone who's interested how I attack the markets and how I think about investing. So I hope you enjoy. So just a quick little reminder, as in previous videos, I have also created a set of videos that explains in very much detail all the steps I go through, how I put all these indicators and analysis together. So I will link to those videos in the description if you are curious and want to know more. So without further ado, let's jump into the analysis. So here we go, straight into it. Just a quick little reminder for those who are new to this type of analysis. I'll just quickly run through my process. So we've got my 13 indicators that I track here. Their predictive power classification, that is whether they're a leading or lagging indicator. The predictive power weighting based on that classification. The date of the data, which also gives me a time weight. The older the data, the less weight it gets. The newer the data, the greater weight it gets. That gives me then a total weighting, and then I go ahead and look at the indicators for the current period, decide whether the direction of the indicator is either decreasing, flat, or increasing, the rate of change of the indicator, whether it's accelerating, steady, or decelerating, and based on those two ratings, I get a score. I then take that score, use against the total weight, and I come up with a conversion to a 10-point scale, which then gives me a total risk score, in this case for January 2020 of 3.5. So like I mentioned, a little bit down month over month. A quick little shot here of December shows it was 4.3, so sitting now at 3.5. Major indicators contributing to that rollover are actually in labor, which is a little bit surprising given that unemployment remains low, but jobless claims, continuing jobless claims have crept up a little bit, and the unemployment rate is starting to kind of flatten out to start to a little bit of an increase there, at least on a trailing period basis. So interesting. Labor also usually goes along with consumer indicators, being consumer confidence and retail sales. Consumer confidence has also flattened out a little bit here, so it'll be interesting to see with those indicators what that might mean going forward here as we move into the next few months. Usually, seasonally strong time for the markets. As I said, the S&P 500 is rocketing to new highs, so we'll see if that momentum continues regardless of what these indicators are saying. So like I said, should be interesting times ahead. So a quick shot here at December, like I said, 4.3. So some of those indicators, especially in the labor area, weren't nearly as bad as they were in January. So yeah, so we'll have to see what that says. So based on that risk score, I then look at my asset class allocations. Again, risk score ranges, min and max down here, translate to an asset class allocation, equities being the risky asset class, and the other ones being more or less hiding places for me to take cover when things are getting a bit choppy. So as you can see, the risk score as it comes down towards zero, equities comes down towards zero, and the other more risk-averse asset classes take a little bit more prominence in my portfolio. So in this case, we are right around here. Again, not too high on the scale. These sort of guidelines are actually based on the minimums here. So if we translate that into the actual score, which is about 3.5, equities are a little bit higher at around 37%, but still definitely not above that 50% mark yet at all. And that's kind of where it was in December, was around 50%, so we're back down under the halfway mark. So it should be interesting here. So if we look at the risk score over time, going back to June when I started this video series, 4.92 in June. As you can see, it kind of came down to a bottom in August. September, October in that 3 range. November took a dip, December bounced back, and then January's rolled over again. So it's up and down. Again, I don't take this indicator and run out and immediately allocate my portfolio according to what it's telling me. I track it over time and I watch it for trends. Right now I probably have about a 40-45% weighting of equities in my portfolio. So maybe looking for opportunities to trim if they present themselves, but right now, given the way the market's moving, sometimes you just have to sort of watch the trend and kind of go with it for a little bit. Again, I'll be watching these very closely. If things start to roll over more consistently, or kind of take a harder turn down, then obviously I'll be looking for opportunities to trim those positions, trying to sell as the market rises, which is always better than selling when it's falling. So yeah, that's kind of what I look at. Again, not looking to clamor for the exits, but just looking to see what that macro economic environment is doing. It's always better to check the weather before you step outside, especially when you're dealing with money. And yeah, I hope that kind of gives you an idea of at least where I think we might be currently, and my conservative approach based on that score. So I hope that helps. So I hope that video was helpful for you. This is something I do for myself, like I said, monthly. Takes maybe a couple hours, not that much effort, but for me really helps me understand, with all the noise out there, all the chatter, all the great ideas, talks of tariffs or not, or whatever. It really helps ground me and help me focus on the data, not whatever, reacting emotionally to whatever I'm hearing in the media. So that's really why I do it. It also helps me just guide my portfolio structure accordingly. I find with something like this, it will often tell me something different than what I'm hearing outside, but that's always a good thing, I find, usually, because when there's fear, you want to be buying. When there's greed, you want to be selling, as we've heard Warren Buffett and others talk about many times before. So if you did like the video, do give me a thumbs up. If you're new to my channel, haven't yet subscribed, like this content, or want to see other things from me that are similar in nature, feel free to hit the subscribe button, and of course hit me up in the comments as well. I'd like to hear from you, your own maybe strategy on how you understand what's going on in the macro world, and how maybe you structure your portfolio also. So until next time, thank you very much for watching.